everybody to come. Here, okay, we're getting some attendees rolling in, so I'll give it a couple more seconds before we kick this off. Okay, hi everyone. Welcome to the Tax Facts Lunch and Learn hosted by Wyoming Tax Facts and the Equality State Policy Center. My name is Marissa Carpio and I am the Policy Director of the Equality State Policy Center. ESPC is a nonpartisan, nonprofit, coalition-based organization advocating for fair elections and transparent government for all of Wyoming's communities. I will be assisting today with questions and conversations that arise among the audience during the webinar. Please use the Q&A feature to ask the speakers any questions. There is an option there to submit anonymously. You can also use the chat feature to share resources, reactions, and participate in the conversation further. Please remain respectful in the chat and remember that this is not a confidential feature. And with that, I'll pass it along to Sue Summers to introduce herself and the speaker today.
Hi, I'm Sue Summers. I'm co-founder of Wyoming Tax Facts. We are Wyomingites committed to a stable economic future for our state by increasing tax literacy in our communities and promoting tax reform. Wyoming Tax Facts is a sponsored project of the Wyoming Community Foundation, and our website is wyomingtaxfacts.org. First, I want to apologize for scheduling this on top of a joint revenue committee meeting. But we'll probably be having, I'll be watching the Revenue Committee in a watch back on YouTube, and they can watch this webinar on YouTube themselves. So we hope to have lots of people check it out. Just to a comment about our topic today, wind energy. The reason we focused on wind energy is two reasons. One is it is the non-fossil fuel energy source that is being developed the most right now and has a tax policy associated with it in our state. In the future, there's going to be a lot more probably, but for now it's wind. And also because Wyoming Tax Facts is keenly interested in broadening the tax base, and wind is doing that. So that's our real reason for talking about wind today. Our guest today is Kara Fornstrom. She's a product of UW and the University of Nebraska College of Law. She started her professional career in the water division of the Wyoming Attorney General's office, working on the North Platte River litigation. In 2000, she co-founded Hageman and Brighton, PC, where she focused her practice on water and natural resource issues. Governor Meade appointed Kara to the Public Service Commission in 2013. She was reappointed to a second term by Governor Gordon in 2019, at which time she became chairman of the commission. In 2022, Kara joined the Southwest Power Pool as Director of State Regulatory Policy, where she focused on expanding electricity markets in the Western Interconnection. Kara was named the director of UW's Center for Energy Regulation and Policy Analysis at the School of Energy Resources in December 2022. She and her family live in Pine Bluffs. Welcome, Kara. Thank you for joining us. Take it away.
Thank you. Oh, I'm going to stop my video for just a second, make sure I can get my screen shared here. Can you see my slides? Okay, great. Well, thank you, Sue and Marissa, for inviting me to join you all today. I'm going to go through some different things about the wind industry, obviously some tax policies and some revenue considerations. Before I get started, though, I want to spend a little bit of time talking about the School of Energy Resources and my role there. The School of Energy Resources was founded in 2008, and we have a mission of energy-driven economic development for Wyoming, which means we focus on incremental revenue opportunities for legacy resources as well as emerging technologies. The research part of the School of Energy Resources has organized itself around centers of excellence, and you'll see those listed here on the screen. As Sue mentioned in my introduction, I'm the director of the Center for Energy Regulation and Policy Analysis. So all of my colleagues in these other centers, the yellow ones are within School of Energy Resources, the brown are located around campus, are led by typically PhD subject matter experts, very much focused on the technical aspects of their work. Our team brings in the regulatory and policy issues to ensure that Wyoming is ready for these emerging technologies in those frameworks. At SERPA, we have three main functions: research, policy support, and stakeholder engagement. In our research work, we do white papers, not necessarily peer-reviewed work like many of our colleagues, trying to address emerging issues that Wyoming industry, people that are engaged in the energy industry would want to be reading, and things that we can highlight for them. In the policy support function, we monitor legislative agencies. We work closely with the governor's office, with the Energy Authority, and try to help provide objective information for commenting opportunities for many of the federal proposed rules. Our stakeholder engagement function is just that. We engage with those in the energy industry directly. So Petroleum Association, Mining Association, Taxpayers Association, Business Alliance, et cetera. And engaging with them more directly really helps us keep our ear to the ground to inform our research work, to make sure we're addressing the issues that would be most relevant for those engaged in Wyoming's energy industry. Also, as part of our stakeholder engagement, we have developed a podcast. It's recently been launched about a month ago. Encourage all of you to find that on Spotify. We dropped our 4th episode today. That comes every Wednesday. It's called Energy Frontier, the Wyoming Landscape. So I encourage you to take a look at that. Today, I'm going to spend some time on background, kind of setting the stage for different issues around the wind industry, talk about the types of wind projects. Then we're going to talk about the federal tax credit systems around wind energy, and then state taxes and incentives. I'm going to summarize some of the economic impacts that have been studied of the Wyoming industry and give you some key points from that work, and then finish with some current issues that you can be keeping your eye on as this issue continues to be discussed and developed. So in the background section, I'm going to start with some wind facts and then talk about the benefits to landowners and how these wind energy projects really work for landowners. We'll do some global or some generation statistics, global in US and Wyoming. We're going to look at the life cycle emissions profile, levelized cost of electricity, energy intensity, and interconnection queues. These are some Wyoming wind facts that I compiled from a publication that American Clean Power did this year. And you'll see on your screen that we ranked 24th in operating capacity at about 3,500 megawatts. Our generation is at about 21%. You see our energy workforce there, the property, state, and local taxes paid in 2021, what the landowner payments are, and the CO2 emissions avoided by using this type of generation as opposed to a fossil type of generation. Many landowners in Wyoming have benefited from wind leases, and I wanted to just talk about briefly what the components of those wind leases typically look like. The first part of that is really an option agreement, where the landowner leases to a wind company the option for them to develop wind energy on their property. That period typically includes some study of the wind speeds, what locations might be best, and that period can vary from a year to 5 years, but there's typically an annual payment to basically reserve that land for potential future development. That option agreement typically also includes provisions around the operating provision or the operation agreement so that the landowner and the company know what the terms of that contract and arrangement will be. Typically, there's a per turbine compensation. So for every turbine constructed on a landowner's property, they get a flat fee. And then there's typically a monthly royalty payment. This is usually based on gross revenues of what that wind turbine is actually producing. And they typically have an escalation clause to increase that amount to the landowner over time. Typically, wind projects are about 20 years. Sometimes they can go to 30, but often there's an option to extend the lease beyond that for perhaps repowering or a different configuration. This next slide shows from a global perspective the share of electricity production by different sources. And you'll see it over time from 1985 until very recently. And you'll see at the top line that coal is still the dominant global generation resource for electricity. Gas has increased significantly, and that has occurred in the United States as well. Hydropower has stayed fairly steady. Nuclear has declined. And then you'll see the wind line there that has gone from basically zero up to almost match nuclear in terms of electricity production globally. The slide on the right, the chart on the right side of the slide shows you the decreasing and increasing trends. So you can see the delta in these lines of what's increasing. Interestingly, from a global perspective, coal and gas is actually increasing over time as an electricity source. And then you'll see the declining resources listed there of hydro, nuclear, et cetera. And then you'll see wind and solar on that bottom line coming up, increasing by 13% over time. This graph shows annual wind capacity growth in the United States from 2010 to 2023. Now, I want to be clear, this is not cumulative. This is what's happening on an annual basis based on nameplate capacity. And there's a difference between nameplate capacity and what a turbine actually produces, what it actually generates. So for example, a wind turbine, let's say a wind farm has nameplate capacity of 100 megawatts. So perhaps they have 50 turbines that are each 2 megawatts each. A net capacity factor that seemed to be pretty positive for a wind farm is about 40%. And so the actual generation from that plant would average 40 megawatts, not the 100 that is the nameplate. But you'll see on this chart, this is nameplate capacity, and you'll see that it has been declining in terms of annual additions over the last couple of years. Many experts say that that is really due to interest rates and other things going on, perhaps some saturation in the markets where wind energy is the most prolific. But you'll see that change over time. Similarly, we're seeing a drop off in actual wind generation hours for the first time. This is data from EIA that shows in 2022 to 2023, we actually saw a drop of that energy that's being produced from wind farms. And you'll see how it's increased pretty dramatically since 2000, but we've started to see this drop off just in the last year. It's slight, but it is the first decrease we've seen since 2000. For Wyoming's generation mix, you can see on this chart that it has changed dramatically as well. And this is fairly typical across the country. We obviously started in a much higher coal generation intensity than many other states, with 97% of our electricity being produced from coal in 2003. You'll see our hydro numbers stay fairly consistent. We have added a little bit of natural gas, but you'll see the real difference here is between coal and wind. Between 2012, 2022, how those numbers have changed. And obviously, when we talk about wind, one of the major advantages of wind is that the fuel source, the wind, is emissions free. There's no CO2 in that fuel source. However, many are now looking and have looked for some time about the life cycle CO2 emissions from a wind turbine. And so this is just a quick reminder that the tower and the blades and everything that goes into making a wind tower does have CO2 emissions associated with it. It really is only the fuel aspect of wind energy that is CO2 free. An area that has been further developed of recent, as we've looked at higher penetration of wind coming into our electrical system, is what we call the levelized cost of electricity. And you'll see here some different bars, and so I want to walk through that quickly. When you try to compare the cost associated with different generating resources, it's tempting sometimes to just look at the fuel source, the commodity itself, and make that valuation. And what we're finding across the country, really, and across the world, is that there are other costs associated with bringing different types of electricity sources onto the grid than just the fuel source. And so you'll see this more complex analysis here to try to get an accurate assessment between generating resources of what the actual cost is. And so you'll see what coal and natural gas are, that really is mostly fuel-based in the gray areas. When we look specifically at wind, many experts are now factoring in the other costs associated with bringing wind in to calculate what the actual cost of that electricity is. So in the big gray bar, you'll see curtailment and overbuilding. We're seeing this in markets mostly like California, for example, where they can only put so much wind on the system at a time. And oftentimes in California, this is true for solar more in California than it is for wind, they have to shut down some of the wind because they can't take it onto the grid because of the other services that are needed for balancing. So what is the cost of overbuilding resources that you can't use even 40% of the time? Another big factor with this are the transmission costs that it takes to connect these wind resources. Typically, they're located in places that are more remote and not have been traditionally connected to the grid. So transmission has to be constructed to connect those resources. And so what is that cost? You'll see some other things there in terms of O&M, property taxes, load balancing. Those are kind of grid services. But I just wanted you to get a sense of some of the other factors that experts in the electricity industry are looking at to try to make accurate comparisons from an economic perspective about the cost of different electricity resources. Another,
sure. Just one moment. A couple of slides back, we have a question on the wind generation numbers. So the question is, curious what the small drop off in wind generation might be related to, supply chain issues or costs? Yeah, I believe it's this slide.
Okay. Again, I think if we go back to this slide and you see the additions are decreasing, I do believe it's a lot of it is interest rates making the projects perhaps not as profitable as they would have been from a financing perspective. The interconnection queue, which we're going to talk about in a minute, is also an issue, how quickly you can actually get these projects online because of the transmission infrastructure that is needed to connect them. And like I said, there are some areas where wind has been really well built out. Kansas is a good example, other states, and perhaps there are less opportunities to be building wind in those areas. So I think it's a combination of factors. And then I think this slide in terms of actual generation really is about some of the other issues that we were talking about in terms of curtailment and some of the other issues associated with actual generation and putting this type of electricity onto the grid.
Great. Okay, one more question came in on the last slide we were on previously before I interrupted you. It says, does the LCOE on coal include the destruction of the aquifer, reclamation, etc.? The lack of capital costs on that line item is striking to me.
And I guess I didn't put my source on this. I don't know that reclamation costs are included. Those are, in a utility model, those are included in the overall cost of the project when the CPCN is issued. I can't answer specifically about some of those factors. I don't see those specifically listed as categories below.
Thank you.
Okay, so another issue that we've talked about in the electricity industry is energy intensity. How much land does it take to produce a megawatt of electricity from these various sources? And you'll see that here that the fossil and nuclear, kind of those base load resources, have a much less footprint in terms of land use to produce that actual megawatt. And then I talked about this briefly a minute ago, but this is just an illustration of the interconnection queue from 2010 to 2023. And this is what every utility has, every electricity market across the country has what they call an interconnection queue. So these are projects that want to come online and they get into the queue to be studied from an engineering perspective, really to look at the transmission and see if the infrastructure is adequate to add these resources. And so you'll see in 2010, kind of the resources that were installed, and you'll see the wind number there, and what the queues were. And you'll see even in 2010, the queue was dominated by wind resources. What you see in 2023 is interesting in terms of installed. You'll see how much gas has increased over time, but you'll look at the queue, and there are a couple of things here that I wanted to point out about the queue. First of all, from 2010, you can see that the queue is about half of what the installed capacity was. That relationship has completely flipped. The queues are now 2 or 3 times actual installation of projects that are being proposed to come online. You'll also see the nature of those projects is much different. There's a lot of solar in a lot of people's queues today, but this is causing delays in development of these projects because of the studies and the congestion in the queues and the technical studies necessary, and how some of that is being sequentially studied has caused huge delays. And every utility is struggling with this. Every electricity market across the country is struggling with this. Sometimes it takes 3 or 4 years to get through the queue. There have been interconnection queue reform efforts made across the country to try to address the length of time that it takes and the cost it takes to get these studies completed and to move these projects onto the grid more quickly. Typically, just to tell you briefly what the problem is. So let's say there are 50 in the queue, and maybe you're up to number 5, but number 3 drops out. And so the studies that you'd had for number 5, assuming that 1 through 4 are coming online, is no longer the case. So 3 drops out, and you have to restudy what the grid looks like without 3 in there. And so there's a lot of movement within the grid. There's been reform efforts to try to increase the financial requirements, so people are serious when they get in the grid, that they're actually, or in the queue, that they're actually going to develop that project. But interconnection queue reform is a big issue and is causing significant delays for these types of projects across the country. All right, switch gears now and talk about the types of energy projects. And we have both of these types of projects in Wyoming. There's the utility model and then an independent power producer model. So the utility model, and really the distinction between these is how costs are recovered from the project. In a utility model, they analyze their supply and demand basically through the integrated resource planning process. They look out 20 years and see what they think their demand is going to be, match it up against their generation, and if they see a void, they then do an economic analysis to see what types of projects would be most economical to bring onto their system to meet that generation gap. Cost recovery for a utility, as many of you know, goes through the Public Service Commission. First, they get a CPCN, a Certificate of Public Convenience and Necessity, which really is a showing that the commission that project is needed. The economics are not a huge aspect of that part of the filing. That comes in the rate case. But in a utility model, you have captive ratepayers. And so once the project is approved by the commission, then the cost would be recovered in a rate case following that. Then the utility gets return of that investment, so what the project cost, and they get return on that investment, a return on equity. And so that's how the costs are recovered for wind projects in the utility model. The independent power producers is much more a transaction that you would anticipate, where a business basically goes out and develops a resource, and then they go onto the grid themselves. They enter into power purchase agreements with other utilities or within a market to sell their electricity based on what they think they need to make their project profitable. There is also a model where independent power producers may develop the project and get it up and running and then sell it to a utility. And the utility would then bring it within their system of projects. So there are different ways to go about it, but those two models are very different from a cost recovery perspective. And here's just a quick example of how a power purchase agreement would work. You have the producer who then signs an agreement with a supplier, and you can see the different components of that and how that works through. An important aspect of both of those business models from a cost recovery perspective are the federal tax credits for wind energy.
And Kara, we have just one more question.
Oh, I'm sorry, sure. I should have paused. I'm sorry, Marissa, before I went to the next section.
We have a question that says, I don't understand why the costs of solar and wind are so much higher. New nuclear plants and new coal and gas plants are very expensive and few are built.
Okay, and I wanted to be clear that this is existing resources for the coal, natural gas versus bringing on new wind and solar. So this factors in what they've already paid for their investment and what it's costing to continue to use that as an electricity resource. It's not you can't build a coal plant today. So we couldn't even get a number for that per EPA regulations. So I just want to clarify, this is existing versus new. It's not a comparative, but we've got our existing electricity system with our existing generating resources. And when we talk about bringing on new ones, what is the levelized cost of electricity of those resources when you factor in all the costs around them, not just the fuel source?
Thank you.
And Kara, I'd like to jump in with a little question about the utilities versus independent producers. Maybe you were going to already provide a few examples of what we see in Wyoming, like who is doing what, which is which, and also if utilities have to answer to the Public Service Commission, then how do the rates charged by independent producers, assuming they eventually reach a residential customer, for instance, is there any protection against overpriced electricity?
Thanks, Sue. I'll try to answer those. So just some examples. I think early on, most of the wind projects in Wyoming were utility based. The Boswell projects, all the ones at Arlington, Minnie, and Natrona County are Rocky Mountain Power projects that were built via the utility model. Obviously, the Anschutz project that's being developed in Carbon County is an independent power producer, and they are seeking customers for that wind electricity through power purchase agreements. Some of those may be utilities. I think they're looking to trade into a market, which is different. We're not in an full-blown electricity market in Wyoming. We continue to trade on a bilateral basis for the most part. Our major utilities are in real-time electricity markets, but that only represents about 5% of their transactions. And so these power purchase agreements, they have to be, in our setting, they have to be economically advantageous to a utility. Can they enter into a power purchase agreement for less than they would building their own project? And I think that has been true in many cases in Wyoming. Some of these projects that Rocky Mountain Power, Black Hills maybe even have brought on were initially developed by an independent power producer and then purchased by the utility, and then cost recovery switches a little bit. But the independent power producer probably has more incentive, I would say, to make sure that they're able to sell their electricity at a rate where they can find a buyer. Whereas the utility model, that's really what the commission is. They're a proxy for that competition to ensure that economic decisions are being made on behalf of ratepayers. And they have a couple of different levels of review to try to make sure that is occurring. Did I answer your questions?
Yes, actually. So actually, consumers would be more likely to get a better deal from an independent producer than from a, well, there's reasons to keep costs sane for both of them.
Yeah, I don't know that I could say either one would be a better cost for consumers. There are differences within the two cost recovery models that we've talked about. I'm sure there are some, some power purchase agreements are pretty high, and were higher, I think, earlier than they are today. And then what the utility can do, and that is sometimes complicated by where that land is. What are the costs of permitting, land acquisition, et cetera. So I don't think you can say that one is better than the other. I think there are probably examples on both sides where things are more economical than others.
Thank you.
Sure. All right, let's talk about federal tax credits. It's been a significant part of developing wind energy in this country. Tax credits have historically been used to assist emerging technologies become economically viable, and we've seen just huge success stories. that the federal tax credits have been able to provide to increase penetration of wind energy across the country. So on the left side, you'll see in millions of 2022 dollars federal energy subsidies for that fiscal year. And you'll see the different categories there. The one in the middle, the high bar, is the category of renewables. It's 15,589. And then when you look at the chart on the right, it breaks down that 15,589 into the different renewable categories within the tax code where federal tax credits are allowed. And you'll see that the ITCs, the tax credits for solar, are more than what we're seeing for wind. But you'll see there just the breakdown of what those federal tax credits look like across those different sectors. The production tax credit has had an interesting history of stops and starts and stops and starts. And it would be interesting to correlate this chart with the earlier one we saw with the annual additions of nameplate capacity, because when the federal tax credit was set to expire, wind development typically stopped, or at least slowed, maybe not stopped, because the tax credit is so important for them to be able to recoup the capital costs related to their projects. So you'll see here in the legislation initially authorizing the PTCs, there was always an expiration date. And then those of you that have followed this know that it would get close to it and then it would be extended. Sometimes it would be extended the day before it was set to expire. And for an industry who's trying to determine how to finance their project, this has been very difficult to have certainty around the tax implications around the projects. As I understand it now, the PTCs that are in the Inflation Reduction Act are more or less permanent. They are no longer based on an actual sunset date. They're based on a penetration amount of wind electricity across the country. And so I think most developers will say that they believe the PTCs are here to stay for some time. And those are $18, I believe, per megawatt. So every time you can produce a megawatt of electricity from your wind turbine, you get a federal tax credit. And that number is a significant line item in the financing of these projects. It's over the first 10 years. So you know what kind of offset you have to any income to make these projects more financially attractive. What we've seen, though, from the federal tax credits, and I just wanted to point this out, this is the price contour map from the Southwest Power Pool. They're a wholesale electricity market that serves 14 states in the Eastern Interconnection, headquartered in Little Rock, Arkansas. They have this price contour map that's updated every minute of every day. And you'll see on the left-hand side what the prices of electricity are by the color code. So you can get up to about $1,500 per megawatt. Sometimes it's higher than that. But if you look at this map and it's red, you know there are some shortages in the system and there are some issues. Then the electricity prices are very high. The purple, on the other hand, represents negative prices. And so what the federal tax credits have introduced into these markets is negatively priced electricity, which is difficult in an economic market to say a commodity like electricity has negative value. So in these situations, you'll see there in the Dakotas this morning that whoever was producing the electricity there was actually paying someone to take their electricity. And so in the day ahead market, when people are bidding into the market, how much can I provide a megawatt of electricity for? The wind industry can say, because they know they're getting a production tax credit if they produce that megawatt, anything they can pay up to $15 negative price. They can say, I'll give you, I'll pay you $15 per megawatt to take my electricity because I'm going to make 18 on the federal tax credit. And so it's caused some distortions, as economic models would, to have that electricity commodity be negatively priced. And obviously we've seen this all over the country and other wholesale electricity markets, putting pressure on those generators who do have a fuel cost, who cannot bid into the market at a negative price. And so it's put on a lot of economic pressure and has led to retirements of many thermal, especially coal resources, because they cannot compete into the market at negative prices for sustained periods. All right, we're going to switch gears now and talk a little bit about state taxes and incentives for energy projects. And I'm going to start with an apology about this slide. It's terrible. It has a lot of information in it, but for those of you that are going to get the slide deck, you can refer to this. Really what I wanted to show you, this is a comparison of Western states and the different categories of taxes and incentives that different states have on wind. And I just want to go through the categories with you quickly, and then you can look at this more in depth at a later time. The state corporate income tax rate, state gross receipts for a business tax, the exemption from a business tax, sales tax, property tax, a depreciation method that's allowed, which obviously has a big impact on the financial structure of these projects, and then specific taxes like we have in Wyoming. So let's talk more specifically about Wyoming. The legislature authorized in statute 3922-101 to 111 generation tax, and it's $1 per megawatt 3 years after the project starts. And that tax is generated, it is split 60% to the counties and 40% to the general fund. And you'll see on the screen now what that generation tax has amounted to since 2014. You'll see how much the state general fund has made, how much local entities have made, and then the total. And you'll see we kind of peaked in 2020. It has been less than that, pretty steady for 2021 and 2022. And at this point, there are 6 counties that are benefiting from this generation tax. Converse, by far, is getting the most receipts from that. Carbon, Natrona, Uinta, Albany, and Laramie. Obviously, that will likely change with the Anschutz projects in Carbon County. And you'll note that those counties are not the same counties that are probably receiving other benefits from a tax perspective of other generation resources like coal, for example. All right, a couple of studies that have been done recently. This one by the School of Energy Resources in 2022, worked with our friends at the College of Business in the CBEA, where they looked at 3 different deployment scenarios. A low scenario where Wyoming adds an additional 2 gigawatts. And again, we're at 3.5 gigawatts of installed today. Moderate scenarios where we more than double, and then aggressive scenarios where more than triple that. Some key findings from that in terms of employment calculations. And I think we all know this intuitively, but the construction phase of these projects are a significant employment boost for the communities and the counties where they occur. So this just gives you a sense of what those construction jobs look like compared to a permanent job based on these different scenarios. They also looked at enhancing the tax revenues within these 3 scenarios. And you'll see the addition in tax revenues that this is not just the generation tax, this would be property tax, sales tax, all of the taxes, what you would expect based on those kinds of scenarios from a tax revenue and a federal royalty perspective. Another study was done by Dr. Godby and Dr. Cook in 2019, also College of Business at the University of Wyoming, where they looked at the state taxation policies across the West and tried to make some determinations about how sensitive wind projects are to the tax landscape in terms of where they might decide to build their project. And obviously you have to have the wind resource, but many states have a good wind resource like Wyoming. And so to some extent, developers can determine where they want to be doing business. So they looked at, they assumed the projects were 300 megawatts. They assumed identical labor and construction costs for one range of this study, and they assumed a 35% capacity factor, which is what we talked about earlier. How much of that nameplate capacity could you actually depend upon generating from that resource? And these are the ranges that they found in terms of a 20 to 30 year project weighs into the ranges, and also whether you're normalizing things or accepting them as they are. And you'll see some of these ranges can be quite significant based on what the standard assumption versus reality. New Mexico, for example, you'll see that's a pretty wide range to know whether your project can be economical there. One that I would like to point out is just how close the ranges are between Wyoming and Colorado. And we've heard this often in legislative committees from wind developers that because of the generation tax and other things that Wyoming is considering in terms of additional taxes for this industry, it can make us non-competitive with a neighboring state like Colorado. When your prices are that close in terms of cost of development of the project, if we raise taxes and increase that liability, that range would obviously increase, making us less competitive with neighboring states where those projects could likely be developed as well. So this is a common refrain we hear, and this study substantiates the sensitivities of these costs based on tax revenue. All right, just a couple other things I wanted to touch on before we finish today, and then happy to answer any other questions. Current issues facing Wyoming's wind industry. There are a lot of things that are going on in this industry now that specifically, but really related to the broader electricity system, reliability issues across the country based on some of those retirements of thermal resources that I was talking about. Wholesale electricity markets have been in situations where they've had to shed load for the first time in their history because they have not been able to get through a high demand period, typically in the winter. We're seeing that's forcing a review of accreditation standards within those markets. Is wind properly accredited nameplate capacity to actual energy that they can count on when they're doing their assessments to predict reliability? And so there are a lot of issues going on. Still, there's wildlife impact issues the wind industry continues to confront. Not going to get into all of those. I just wanted to put up this as a factor, and I don't have Wyoming in here, but this is just electricity prices increasing across the country. You'll see United States in that blue line, and then a couple of states, California, I think, would say they have been the most aggressive about integrating new resources. It's hard to say what's causing the electricity increases. There's a very complicated issue, but I think it is fair to say that increasing electricity prices across the country and in Wyoming is causing issues for the wind industry, fair or not, to defend whether their increased integration is causing price increases or not. We certainly heard this refrain in the Rocky Mountain Power rate case last year. We're seeing some projects that were permitted, this was an issue in the case, that have not performed economically as predicted. And so again, I'm not saying it's one or the other. I'm just saying this overall pressure on electricity rates has caused some issues around the penetration percentage of wind. Also, the Joint Corporations has formed an interim electricity taxation subcommittee. I think from my understanding of the purpose of the subcommittee is to look at whether the wind development that is going on in Wyoming, mostly from a utility scale, and projects in other states, is causing undue impacts to Wyoming citizens as compared to those that are receiving our electricity. We export about 2/3 of the electricity that we produce in this state, and there's some concern that Wyoming citizens are paying more than their fair share of some of the costs related to some of these new resources. So this subcommittee is a combination of several interim joint committees from minerals, revenue, and corporations. They had their first meeting on May 22nd. Their first task really was to look at 3 bills that were presented in 2024. I don't believe any of them were actually introduced. The first 2 are kind of companion bills, and the third bill is a different way to look at this taxation scheme, but all trying to get at the same thing of making sure the playing field is level between Wyoming citizens who are producing the electricity and those that are demanding to receive it. Interestingly, this subcommittee will be issuing a request for proposal. The committee on the 22nd discussed whether it would be appropriate to separate that RFP into 2 different pieces, that maybe you couldn't find one person to do both of these things. There have been issues raised about the Commerce Clause and whether it is, this tax would be uniform across Wyoming citizens and others. And then obviously want to look at the economic impact. Anytime you tinker with the tax distribution formula, you want to make sure that counties, municipalities, others are being made whole, and that there aren't unintended consequences. And so they want to look at those revenue impacts as well. My final 2 slides are from the Industrial Siting Council, a recent presentation they did at Joint Minerals Committee. I just wanted you to see these are the Industrial Siting Council permits that have been issued for projects that are under construction. This is all industrial projects that have jurisdiction under the ISC. And I just wanted you to see how many of those are wind. You can see what those monthly distributions will be to the impacted communities and counties. And then similarly, just for pending projects, similarly within the Industrial Siting Council, you'll see how many of those are wind as well. And so those are all in the pipeline, so to speak, and we'll continue to monitor what's happening from a revenue perspective with the legislative interim committees, but always more to come. And I don't know that there's ever been a more fascinating time to be engaged in the electricity industry right now, and wind is obviously playing a huge part in that. Happy to answer any other questions.
Marissa, do you have anything you want to bring up from the chat or Q&A?
Yeah, we had a couple, I think back on that, the expenditures or the costs for various types of the new and existing sources.
Okay.
So this one is asked, I'll just wait till we get back to the slide. It's a little easier, but there it was. One of the questions is, did your existing versus new cost study include the proposed nuclear project at Kemmer?
So this isn't my study. This is and I'm sorry that I didn't source it, but no, that would be a new nuclear source. And this one only looks at existing nuclear. I'm sure it doesn't even include Vogel.
Perfect. That's what I thought. I was wondering if you knew of a resource that might have that information, so I could share it.
I think this type of analysis is more and more common. I know EPSA has recently done one. I don't know how much of that study they've actually released. I don't know that nuclear is included, and I think it is. And it's focused on the PJM wholesale electricity market, which is the northeast part of the country. But I know that there's some summary and a slide deck available from their analysis on their website. Again, EPSA, EPSA. They're looking at kind of the overall levelized cost of electricity when you take into account other factors besides fuel.
Perfect. And that would, I think that kind of groups together this other question that I got about the cost for these existing sites. It doesn't seem like they include pre or post reclamation, but maybe that would be the similar resource to find that information.
I assume they probably do include that. Again, just from a coal perspective, I can tell you when a coal plant was approved, what goes into rates includes a reclamation number and a depreciation number. So the life of the project is recouped from ratepayers, again, return of and on, but reclamation is included, depreciation, all of those things are included in the overall cost of the project when the commission approves it. But again, I should have sourced this, I'm sorry. I don't know where I put that, but this is not a Wyoming specific study. My point really was just to introduce the viewers to the concept that there are more costs. You know, there's a whole basket of costs associated with producing electricity, not just the fuel source. And it's becoming, I think, of increasing interest as we're seeing impacts from high penetration of new resources, and I think some unexpected costs, and why is that? So just a broader look. And so we can make economic decisions moving forward for ratepayers so that we can try to stem this seemingly unending increase in electricity prices, which are difficult for everyone.
Thank you. And it looks like Shannon in the chat said Natrium, specifically all of the cost info is currently confidential, and Kara Choquette put in a presentation that you are all welcome to look at. But I think that sums up the questions that I received in the chat. Thank you.
Sure.
Now I might have missed something, but did we go over the sales and property tax situation for wind farms? Because I was curious about the generation tax. Thank you for talking about how that was divided between the state and the counties, that income for them. But the Inside Climate News article that we suggested everyone read before this presentation did go into quite a bit of detail about the communities benefiting from sales and property taxes. So this might be a little redundant, but could you speak to that a little bit too, Kara?
Yeah, I'm sorry, Sue. I didn't get a slide in here on that. That was my oversight. And I don't know that I am probably best to look at that. Obviously, these are huge investments within the counties and increases the property tax assessment across the county. I should have put some of those numbers in there, but I didn't. But we're seeing that. I just would say too, it's interesting to look at that across overall, revenue sources in terms of offset from severance tax, for example, based on declining coal sales. I don't think we're seeing a one-for-one there, but we're certainly seeing, as I mentioned earlier, a different kind of distribution than we've historically seen. The counties that are benefiting from some of those property tax increases and property tax revenues, wind is obviously bringing a diversification of that because those projects are located in different places than where many of these other thermal resources have been located.
Right, and as we learned from Brenda Henson, what county you live in really determines where the wealth comes from or doesn't. If you've got minerals, you're really doing well. And as I've probably said in other webinars, it doesn't seem likely that we will come upon any sort of single resource that'll replace our coal revenues anytime soon. So.
And we got another question in the Q&A. It says, because AI seems to be a game changer when it comes to complex analysis, what discussion is taking place in the field about the role of AI moving forward? For example, with moving through the queues more quickly.
That's a really interesting question. I haven't seen in the industry press, maybe I haven't been looking hard enough on what, if any, impact AI will have on the interconnection queues. Perhaps that will shortcut that. I hadn't really thought about that. What I can tell you AI is having an impact on is electricity demand. We have been very flat in this country for at least the last 10 years. And now we're seeing projected demand increases of 3, 4, 5% in many markets. And that's really due to data center growth to accommodate AI use. I recently learned that an AI search takes 30 times more energy than a typical Google search. And so that explains why we're seeing this just explosion in electricity demand over what we have seen as a very flat demand for a very long time. And we're seeing 4 major markets, I think, where that data center development is growing: Northern Virginia, Phoenix. There are a couple others, but we're seeing huge demand forecast projection increases in a lot of areas like Texas and other places. And so the grid, which many would say is already fairly stressed, is going to have another test to be adding additional demand on it, not to include other electrification efforts with vehicles, buildings, those kinds of things. But again, it's a really fascinating time to be in the electricity industry.
Wow, just when you think you have the answer to everything, it gets more complicated. Marissa, are you seeing anything further? Do we need to post any more links in the chat, or maybe we could? I have a couple of links in the that I could share with the Godby study and that kind of thing.
Yeah, I can find those too and drop them in. I just put the Inside Climate News article link, and we'll also follow up with a recap email with this recording and some of the links that we have mentioned here, just in case you didn't get the chance to save them in the chat as well. So if you can't get to the Godby study, we can definitely send it out in the next email.
Okay, I think I have that right here. Let me drop that in. Let's see. I don't know if I can share that with everybody, but I'm going to try.
I can see it, so I think you were successful.
I might be just going to the hosts and panelists with that. So
I can send it out.
thank you. And I'll probably add links to a bunch of things on the Tax Facts website when I post the link to the ESPC YouTube channel when this goes up.
Right.
Okay. This was a very dense subject, and I think people will be wanting to look at the slide deck. And as we move forward with tax policy on wind, things are likely going to juggle around quite a bit in the legislature. But as others have argued in the past, a nice, stable, even-handed tax policy is always good for business. So hopefully that'll get figured out, and or depending on how the tax subsidies go from the production tax credit, that could really keep throwing a monkey wrench in there for a while. But yeah, I'm not an expert either. I'm just kind of making that up. Thank you, Kara, so much. This has been super informative, and I hope our guests today, our participants, have learned quite a bit and found this interesting.
Well, thanks to you both. I really sincerely appreciate the invitation. I did have my email address in the materials. I'm happy for anyone to reach out to me directly as well. But again, thanks so much for the opportunity. I'll get my slides over if you want to distribute those.
Definitely.
Okay.
Thank
Thank
you.
you.
Thanks, Marissa.
Yeah, thanks everyone. We want to especially thank our sponsor, the Wyoming Community Foundation. Our next webinar will be actually in August. We're taking a little bit of a summer break, so keep an eye out for that topic in that registration. And thank you all so much for joining us, and we'll see you next time.